Hello, everyone. Good morning, good afternoon, uh, good evening to everyone, depending upon where each part of the globe you are. Very warm welcome to all of you to have joined this GT webinar on a very interesting and a hot topic, which is introduction of corporate tax in the UAE. We in India are extremely excited to sort of look at this development. UAE, for various reasons, has attracted the fascination of Indian as an individual visitor, but also as an Western community. Huge relationships going on from several, I would say, centuries. It's only been cemented with the signing of comprehensive economic agreement, which India just signed in February. With UAE bringing in tax, there is a huge amount of certainty that Indian as an investor community sees in the UAE. That has been a bit of a concern in the past, but now that is put to rest with UAE joining the OECD bandwagon and agreeing to adhere to the BEPS Pillar 2 program, with OECD announcing a detailed set of rules. This space is very, very exciting, and we're just starting. It's just tip of the iceberg. So we have very interesting set of topics lined up to be shared with all of you. We have experts from our Middle Eastern practice. We have experts from India. So we're going to talk about some of the things that we have heard in the past. The detailed rules are not out yet. We might say that they will lies in the details, and therefore, what is there to talk about? I will actually, ask you the question later after the session gets over as to why it still makes sense to talk about it, while the detailed rules are still being formed and or framed by the government. So we have 1 hour session lined up today, followed by 15 minutes of Q&A. We've designed the webinar in a way that kind of addresses the questions that we are hearing from our clients, both in India and Middle East and in UAE. So hopefully those will get answered, but in case you feel there's a specific question which can be asked, which you want to get asked, please submit that in the Q&A section. And if you can't answer that in this session, we will actually cover that on a one-to-one basis. So let me introduce now my panelists. Privilege and honor to welcome Anuj. He's an international tax leader based out of our UAE office. We have Olu, who's a transfer pricing manager. He's also based out of the UAE office. We have Sridhar, who is from India, chartered accountant, international tax expert. Has looked at various structures globally, including the clients investing in the UAE or through the UAE as a holding company or as a trading company. I also have Manish, who's a corporate tax partner. So we understand that there will be nuances which we have to look at with corporate tax coming in. So how does the situation change? So that's the backdrop. So if we can get the slides up, please. All right, thanks. So that's the agenda. As already mentioned, we'll talk about the tax landscape in a fair bit of detail. We'll talk about specifically the corporate tax features to the extent they're applicable generally, or free trade zones. We'll talk about transfer pricing regulations as well. And lastly, how does it impact the clients? What is it that they should be doing between now, next 3 months, next 6 months? So that's the agenda we have for you. Hope to have an interactive session. With this, I hand it over to Anuj. Anuj, all yours.
Thanks, Ajay. Good afternoon, everyone from UAE. Pleasure to have your company, and thanks for your participation. We hope that this session not only answers some of the questions you might have with respect to your UAE operations, but it also lends some practical perspective as to how to prepare for this development, not just for today, tomorrow, but beyond 2023 as well. So as Ajay mentioned, the development is huge, and it's always beneficial in order to measure the far-reaching impact of a development of this magnitude to assess, where is this coming from? And I fully appreciate some of us might already have heard and read something about the UAE tax announcement, the corporate tax announcement, and also been in the groove for various other tax compliances which the country has seen in the recent past. However, if we could just take half a step back, this all probably started back in 2017 when the big brothers in EU and the G20 countries, when they assessed tax as some sort of a sector contributing towards their macroeconomic budget, irrespective of the existing tax legislations, the treaty networks, books and books of tax literature, anti-tax avoidance measures. There was still a measure of close to $200 million annually being lost on account of tax leakages. And when they peeped out from their window, they ought to look at countries which were either nil tax jurisdictions or low tax jurisdictions. And that was when UAE came to the center stage within the Middle East and closer to home, even Bahrain to some extent, wherein whether it's on account of free trade zone setups or whether it's on account of simplistic corporate tax profiles, where a very limited amount of tax was levied in the past on certain category of sectors, there was a notion that, okay, is there erosion of taxable base? Are profits being shifted to these low tax jurisdictions? So UAE came in the limelight, and from there on, it had to commit in order to walk the walk with the EU, wherein a huge reliance of foreign direct investment continues to be in play. And also closer to home, Saudi Arabia being a G20 member, all of these meant that UAE had to commit to adopt the minimum BEPS standards. This then led to economic substance regulations coming into being, country by country reporting being implemented. On the consumption side, we saw indirect taxes landscape being expanded from customs, came in VAT, came in excise. But on the international tax side of things, so far, these developments were more to do with enhanced disclosures, enhanced filings being made in terms of the economic profits, which belong to UAE as a federal. And there was no taxable event. There was no actual tax cash outflow as a consequence of these compliance requirements. However, they have played an important part, if I can say this, to lay down what we can say as a reasonable taxable base, by parking the profits in the UAE as a federal, by acknowledging them through these country by country reportings or ESR filings, paying VAT transaction by transaction, however, consolidatedly filing the VAT returns as an entity or a group. All of this has solidified what true economic profits always belong to UAE, and to what extent these profits now can be subjected to some sort of a corporate taxation. So the announcement came in as a very natural transition from being subject to minimum governance under BEPS. The developments globally around BEPS measures being BEPS 2.0 and Pillar 2 coming into play, and thereby many countries who are committed to the inclusive framework of BEPS standards adopting some sort of new tax measures into their existing tax legislation, or some countries like UAE making a debut event whereby for the first time corporate tax and transfer pricing will be locally rolled out. Moving to the next slide. So I'm reasonably sure many of us might have already heard or read some of these announcements. Hopefully what we are discussing in the next 15-20 minutes will also bust some myths which we might be carrying, or maybe give some more granular details to the extent we know. It's fair to say that so far we have had formal announcements coming from the UAE Ministry of Finance and also the Federal Tax Authority, and also a very detailed tax FAQ, frequently asked questions, being rolled out as a measure of formal communication on the intent and the overall direction in which this new law is anticipated to be rolled out. Of course, closer to home, across GCC, other than UAE and Bahrain, we have been used to seeing all corporate tax measures being in play, be it Saudi Arabia, Oman, Kuwait, even farther east into Egypt, Jordan, and many corporate houses who tend to have a regional headquarter out of UAE do have a regional footprint. And we expect UAE to not reinvent the wheel or discover something new, but adopt international tax principles and also take learnings from the local indirect tax rollouts in the past, as well as draw inferences from their neighbors as to how to govern, manage, and effectively collect corporate tax revenues, including transfer pricing compliance requirements. So what we know so far, the headline rate suggested is 9%. It's still the most competitive across the world. I'm not in the know of any other country which has a rate of 9%. There is a linkage to the subject to tax rules coming from Pillar 2, wherein any rate below 9% could have adversarial withholding tax impacts of money flowing into a country like UAE. So that there's also a technical connotation to it. I think it's important to note that this is a federal level law. So while many of us in the past have been used to seeing emirate level practices being followed, even if the announcement would happen at the federal level, the practical implementation or the governance would be at the emirate level. But this is not the case in this instance. Very similar to VAT rollout and very similar to economic substance regulations rollout. It's a federal level law, and there is no leg of emirate level administration or implementation to deviate from the central structure. Given the rate is 9%, the overall messaging is of a very inclusive framework, which means only very limited exemptions or exceptions would be laid out or expected to be laid out upfront. And any other benefits, exemptions which are offered would be in the form of privileges which will have to be earned, subject to, say, satisfaction of certain conditions or certain documentations, and of course, subject to substance over form as a thumb rule principle. We do expect the formal law to be released by mid-2022 if we go by the formal announcement made in course of what came out as an FAQ. Well, one could debate, one could guess whether it could be sooner or whether it could be later. We do have arguments in favor of both. However, if I was to take a sense check on the ground, I would say sooner rather than later seems to be a more popular belief or a more likely scenario than not. As always, the overall administration is linked to, or the rollout is linked to the financial year of each entity. And this is an interesting part, that while the law will be effective from 1st June 2023, which means as a federal, UAE changes its complexion from being a non-corporate tax jurisdiction to a corporate tax jurisdiction and a transfer pricing jurisdiction. The actual compliance will trigger in driven by the first financial year of any entity after 1st June 2023. So to give you a quick example, if you have a financial year ending on 31st of December, then your first tax year, the profits of which year will be reported to tax, is 1st January 2024 to 31st January 2024. However, since the law actually comes into effect in 1st June 2023 itself, you might have any indirect impact of this because you might have suppliers, contracts, which are grandfathering into a new tax world in the UAE. You might have certain customers who have a different financial year starting sooner than you. So while it is good to link from a compliance perspective to your financial year, the overall impact of this new development has to be seen from a point of view of 1st June 2023 itself. In terms of exceptions, only oil and gas companies which are under a revenue sharing arrangement and also certain investment incomes and individual remunerations like salary and compensation have been kept out of scope, which again indicates a very inclusive nature of the law. Moving to the next slide. So this is how anything connection to taxable base tends to look like in terms of 3 pillars. Of course, the starting point would be accounting profits either based on IFRS or US GAAP principles. However, on expected lines, the taxable income will have to be derived subject to certain deductions, allowances, disallowances. Again, we expect from the announcement that a lot of international tax principles ought to be imbibed, whether it's on account of cap on related party expenses, Again, Olu will cover transfer pricing elements in a bit, and we'll hear more on that in that section. Even from a thin capitalization rules, while there is no formal announcement, but owing to the overall texture of what we are used to seeing, a lot of intercompany loans and debt being in the structure per se, one wouldn't be surprised again to see some level of thin capital utilization or having a cap on the interest expense being overall part of how a taxable income is generated or derived from the accounting base. Important to say that this would lead to tax accounting, as we call it, calculations of deferred tax. How does it impact your balance sheet, asset side or liability side, owing to permanent or temporary differences? While the rate is 9%, owing to certain startups and entrepreneurial structures, 375,000 base has been created to let go of those companies who are not profitable at this leg, and 0% rate would apply. There would still be some minimum compliances expected, like registration and maybe filing a nil tax return, and that would start creating a documentation trail from the word go. Tax losses, again, some generous provisions being promised. No limitation on carry forward of tax losses. Again, all of this focusing on taxing the actual profits made by businesses, and none other than the profit seems to be the focus of application of the tax regime. Moving to the next slide. So within the tax law, we have seen a reference to large multinational enterprises, and there's a clear definition as to who qualifies as a multinational per se, and then the global threshold of UAE 750 million euros, which tantamounts to 3.15 billion dirhams, which triggers the definition of large multinational. The 15% global rate, which has been popularly doing rounds since the time Pillar 2 discussions have started. So UAE is very much committed, and time and again we see press releases from the UAE Ministry of Finance that without blinking an eye, they are going to commit and ensure the rollout of the UAE corporate tax law is done in parallel with adopting the global minimum tax of 15%, whereby if UAE is the ultimate parent entity, then in order to not let go of its right to collect the top-up tax for such multinational groups, large multinational groups, probably UAE should be the jurisdiction who has the right to collect any top-up tax as a difference between the minimum tax of 15% and the effective tax rate for such groups. But more than likely, UAE is going to follow the suit and the overall timelines of the global developments. So it is important to keep a pulse on where the global developments are progressing and how UAE continues to be in the shadow and accordingly to its commitment of adopting these standards in due course. Moving on to the next slide. Free zones, and I can say this with all liberty that this is one topic which has been very popular from the time even economic substance was rolled out, leave alone the corporate tax announcement. I have to start with saying there were a lot of expectations that certain free zones, such as DIFC, ADGM, which are financial free zones, which have been popular and all the more the poster boys for a lot of financial holding structures, the new age fintech or even digital business houses using DIFC and free zones as their setup structures. But I think deviating from the overall expectation to have a plain vanilla exception being created for any free zone, the law comes out to, or the FAQs have clearly stated that all free zones, irrespective of the nature, irrespective of whether they are designated or financial or as the case may be, they are within the remit of the UAE corporate tax law. Now, this doesn't necessarily mean bad news because, technically speaking, there has been a lot of debate on the classic question of whether an entity in UAE is subject to tax versus taxable. And then driven by an answer to that question, what does it do to its credentials of availing a treaty protection? In other words, is it being even taxed or subject to tax in the first place, leave alone availing a double taxation avoidance agreement? So to some extent, bringing free zones into the net of corporate tax should lend some benefit overall to accessing the tax treaty, and then thereby, net being probably beneficial as compared to completely being outside the 120 plus treaty network which UAE has currently. So a lot of benefits could avail. However, locally speaking, there is a mention in the FAQs that the current incentive schemes which the free zones are providing ought to continue subject to satisfaction of these conditions. Now, before I get into the conditions, I think an important connotation here is the mention is about the current incentives. One would like to question and probably see some more granular details when the law comes out as to would there be any grandfathering rules? Would there be a differentiation between existing free zones and existing free zone entities versus new free zones being created and also new entities being set up within the currently existing free trade zone setups? Secondly, does this mean higher governance from an economic substance perspective? Because some of these incentives might require earning these benefits again, rather than making economic substance filings. It could be investment-driven incentives. It could be something driven by ensuring that the overall conditions, and here I come to the critical one being, is there any contamination between the business conducted within the free zone jurisdiction versus transactions being conducted with the mainland? Of course, granular details should bring some more clarity. However, the expected clarity is on the lines that whether these contamination, so as to speak, or conducting business on the mainland, does it necessarily refer to the revenue side of your P&L, or it could also be on the costing side where you might be sourcing some raw material or certain services or any of your costing raw materials, etc., from a supplier who's on the mainland. So to what level be there a governance standard created to not satisfy these conditions and avail the incentives? And also to what extent the contamination leads to a tax outflow. So for example, if I take a free zone which has maybe 20% of its revenue coming from the mainland, would this mean taxing those 20% revenue, just like profits attributable to a permanent establishment concept? Or are we saying, no, because of this 20%, the entire 100% does get contaminated, and hence this is no longer the free zone incentivizing scheme which we envisaged to offer in continuation? But all these are more to do with the questions which we need to find answers to. But one thing is for certain, that probably a free zone entity which is a pure play import and re-export, if there are any elements in addition to such a plain vanilla free zone, which is not a very common thing I have seen on ground within the country, then it's fair to say that there is definitely an impact from a corporate tax and transfer pricing perspective on the free zone structures. One wouldn't put a blind eye and put to rest any corporate tax impact. At the bare minimum, we are talking about registration and maybe even a tax return to be filed. Whether an actual tax outflow happens and to what extent that tax outflow needs to be computed and governed is a question which one will have to find answer to. Moving on to the next slide. So in the interest of time, I'm going to spend little time on the exemptions, so as to speak. So again, going by the underlying thumb rule, passive income, investment income, whether it's form of capital gains, dividends, they are anticipated to be not subject to tax. This further keeps the promise of UAE trying to play its part, or continuing to trying to play its part as a regional headquarters. Also on qualifying intra-group transactions, we are very familiar with seeing similar exemptions being given on the Middle Eastern side. For example, within Saudi Arabia, there are provisions whereby, owing to certain conditions and owing to certain measures being adopted, any intra-group restructuring, for example, is not subject to tax. We're also, I think on the Indian side, we're used to seeing court-driven mergers and demergers availing some of these exemptions. But again, these are privileges. They will have to be qualifyingly earned, and then there will be documentation and governance around making sure the positions taken are accurate. Moving to the next slide. Real estate, I think this is something worth mentioning. I can reasonably say there's a lot of us tend to have real estate exposure in individual capacity or even from a business perspective. So real estate as a sector within UAE has not been given any special privileges, but any investments made in personal capacity by individuals have been given or indicated to be given certain exemptions. Again, what means personal capacity? What would effectively change such a structure to very quickly mean a commerce or a business driven by either the scale or the periodicity of such income being generated? All these are very critical measures which will have to be studied, analyzed, and then applied as soon as the law comes out. On the banking side, again, we know only foreign banks having branches in UAE have historically paid 20% corporate tax. This is about to change, whereby the announcement conveys a transition of these banks into the new realm of corporate tax. One could say the 20% corporate tax being paid by these branches currently seems to be reducing to 9%, and hence could lead to, for example, release of some deferred tax liabilities. However, again, the taxable base needs to be compared, not just the rate, before reaching such conclusions. So again, a lot of work to be done in terms of analyzing the deeper impact of these headline issues, and hence the connotation, the sooner we start, the better. Moving to the next slide. I guess we've covered most of these so far. So if we could move to the next slide, please. Right. Tax grouping, again, a concept which is very popular in the EU world, driven by the UBO details, which have been asked for and filed by many corporate houses within the country. We do realize either for IFRS purposes, either for CBCR purposes, and even for VAT grouping or non-grouping purposes. Some of these positions have already been taken in the recent past. Some of these positions will have to be revisited. Yes, a fiscal consolidation does bring in the advantage of administrative convenience, that you might end up filing only one tax return. The first question which comes to mind is, would this be voluntary or would it be mandatory to file a grouping, a fiscal grouping, one single return? Because that itself could lead to scenarios where you might have free zone and non-free zone entities both in the structure, and it may not be beneficial to consolidate it under one tax return. So going by the same principles adopted internationally, typically this is given as a benefit and not mandated to be followed. However, qualifying the tax grouping, corroborating the previous details of UBO or VAT grouping and IFRS positions again would lead to such a benefit coming your way. Also, archaic 51-49 structures. I think in Middle East, we are very used to seeing economic ownership versus legal ownership being two different concepts altogether. A lot of transparency has been generated in the recent past, but there's more work to do again to fully grasp and take a tax position or a corporate tax position for the first time as to who is really the economic owner, the beneficial owner, and hence is it right to take a tax grouping position and avail the benefits of administrative convenience, or will it cause a further deviation from something which has been done in the past and maybe beneficially working for the group's tax position? Moving on to the next slide. So very quickly, this slide again displays the simplicity which is being trying to implement it, at least on the word go. There's no withholding tax provisions which are being proposed. There are no quarterly filing of any withholding advanced tax measures, any provisional return. But what this means is, yes, the administration is expecting one final tax return which will be submitted on the due date, say, for example, 4 months from end of the financial year, electronically. But this means you get one chance to make an accurate filing. Any resubmissions, any deviations from what is the taxable base, any deviations on accuracy, any errors would lead to what we are very used to saying in this part of the world is system-generated penalties. So while the administration seems to be simple, at times it's difficult to be simple and be accurate on the word go and make that one filing count accurately for your own benefit. Moving to the next slide. So this is where I'll request Olu to bring his experience to bear on the transfer pricing element, what we have seen in the region versus what we are expect to see more closer within our country.
Thank you, Anuj. And hello, everyone, and thank you for being with us so far. In terms of transfer pricing, what we know so far is that formal transfer pricing rules will now be introduced in the UAE alongside the corporate tax laws. Prior to now, there has been no transfer pricing requirement. So in terms of related party transactions, intra-group transactions, there's been no requirement to comply with any sort of transfer pricing rules or prepare any sort of transfer pricing documentation. Going forward, this will change now, and UAE businesses will now be required to ensure that they comply with the transfer pricing rules and regulations that are expected to be released alongside UAE corporate tax law. Now, what we know so far is that the prospective UAE transfer pricing rules and regulations would apply in a consistent manner with the OECD's recommendations in its transfer pricing guidelines. As a lot of you might be familiar, in terms of transfer pricing is generally, most countries generally follow the OECD model. Some in India, that's the case as well. And fundamental to the OECD transfer pricing requirements is the arm's length principle. The arm's length principle, as we all are aware, basically just requires entities are part of a group in terms of where there's a controlled relationship. The arm's length principle requires them to transact with other entities in the same group as if they were transacting with an independent entity. So the terms and conditions of the transactions, of the intra-group transactions, should mirror that will have taken place between independent entities. Now, it's not enough to just say that intra-group transactions follow the arm's length principle. There has to be a demonstration of this. And what we've seen are usually the form by which taxpayers, businesses have been able to demonstrate compliance with the arm's length principle in terms of your intra-group transactions is through transfer pricing documentation. Now, before going to transfer pricing documentation, other aspects do come into play in terms of having, for example, a group transfer pricing policy document. The TP policy, while being an internal document, which is usually for management purposes, but it is fundamental because it helps to set the framework for pricing intra-group transactions. And this can be applied group-wide or customized to a jurisdiction basis. Now, in terms of the expected form of compliance documentation, the master file and the local file transfer pricing documentation are expected to now be introduced in the UAE, given that these form the core of transfer pricing documentation under the OECD transfer pricing guidelines. Now, supporting the local file would be the benchmarking studies. The benchmarking studies analysis basically is where taxpayers are able to demonstrate that they have benchmarked the pricing of their intra-group transactions with the same outcome or pricing that has been adopted by independent entities who are not related to each other, and then using this to support the pricing of their own intra-group transactions. What we've seen so far, looking at the region, so for example, Saudi Arabia in 2019 introduced its own formal transfer pricing rules. Qatar followed suit as well, and now UAE has done the same. Jordan recently also introduced formal transfer pricing rules. What we've seen so far is that transfer pricing requirements typically apply to cross-border transactions, as well as in some instances, domestic transactions. So we expect that in terms of the UAE, the transfer pricing rules would apply not only to cross-border transactions amongst related entities. So for example, in India, head office, for example, and its UAE subsidiary, but we also expect that potentially the transfer pricing rules would apply to transactions between domestic entities in the UAE. So to the extent that there are 2 to 3, for example, UAE-based businesses, and they have transactions amongst themselves, we expect that potentially the UAE transfer pricing rules would apply. This is the case in Saudi Arabia, for example. And then when we also sort of think further and look at, given the fact that free zones will also be subject to the corporate tax law, one can reasonably expect that transactions between entities in the free zone and as well as the mainland UAE would also be subject to transfer pricing requirements. Now, in support of all of this will be intercompany agreements, and it will be critical to ensure that any sort of intercompany agreements that are put in place for the intragroup transactions clearly reflect the actual substance of the transactions in terms of the functions performed by the entities to the transactions, the risk profile, because this would all be backup documentation, again, supporting the arm's length conditions of those intragroup transactions. It will be expected that transfer pricing adjustments would definitely be, will come into effect for non-compliance with the arm's length principle. And while we are waiting the formal transfer pricing rules to be released and also guidelines in terms of what will be the appetite of the FTA to transfer pricing audits, well, we can glean what has been the case in other countries, for example, Saudi Arabia, where there's a dedicated transfer pricing audit unit. And what we've seen so far in terms of transfer pricing audits is that the tax authorities in Saudi Arabia, for example, typically would select taxpayers that are persistent, that recorded consistent losses, or taxpayers with that intragroup transactions with related parties in low tax jurisdictions. They typically get selected for TP audits, as well as certain types of transactions, for example, management service fee transactions, intellectual property transactions, royalties, as well as where we've seen where there's been significant restructuring within the group. So we expect that the FTA might also follow a similar approach to what has been done in Saudi Arabia, for example, given the closeness of both countries, as well as given the fact that Saudi Arabia is a member of the G20, and of course, they also follow the OECD model. In terms of the timelines for compliance documentation, it's well possible that there might be an annual requirement for submission and filing, as is the case in, for example, Qatar and Egypt. And it might also be the case that the documentation might be required to be submitted upon request by the FTA. This all will come to be clear as time goes on, especially when the expected transfer pricing rules are released, as well as any guidelines. So I'm going to hand over to Anuj now to take you to the next slide. Thank you very much.
Thanks, Olu. So I guess then this takes us to the million-dollar question. So okay, we've seen UAE make an announcement. Probably this is on the expected lines. Maybe not for some of us who feel this can maybe make UAE a bit more costlier affair to do business in. So what do we do now? And again, Ajay rightly put out this question right at the opening of the webinar as to why is this so relevant as we speak today in April 2022. So I guess simply speaking, as I see it, I've been in the region for about 10 years now, and I've seen the paradigm change actually evolve year after year, and at times even quarter after quarter. The million-dollar question, whether to wait for the law to come out, whether to or to act now, I think this really depends as to how do you see this impact of this development on each and every business unit within your organization. Because let's make no mistake, a change such as this can be seen as 9% or 15%, as the case may be, being taken away from your net profit. And that would be more of a top-down approach. But if one was to look at the granular details, if one was to look at how various other taxes have been rolled out, debated, the amount of FAQs to be released, the amount of issues to be encountered and solved, the uncertainty around various business models, and UAE is a house to so many business models, so many different variety of structures. a branch license being used for various other commercial activities, an LLC on mainland being 5149. Again, economic versus real ownership. What profits? How do you determine profits, and ultimately, how do you account for your deferred taxes? I mean, there's so many issues to deal with, and with all of these comes the important aspect of communication. The communication with the stakeholders, the decision makers, any recruitment plans, any expansion plans, any acquisitions which you might have in the pipeline. How does the investment rate of return gets determined after this rollout? Any impact on your balance sheet, which is being communicated to your financiers or your bankers, any real estate transactions. All of these and many others, decision making and strategies will be impacted with this so-called 9% rate coming into play. Again, depending upon how do you measure your existing state of affairs from a documentation perspective, transparency in between related party transactions. You spoke about free zones and how will they be governed going forward. It's about looking for the information from a vantage point of corporate tax for the first time. It's about digging the right information and whether your systems, your IT systems, the people managing the financial matters within your organization, are they capable? Are they and with all due respect, there was no need to think about this previously, and now there is. So whether it's about embracing the change, whether it's about reprioritizing some of your board level discussions, and then using this as probably an opportunity to get fitter in terms of your UAE operations, the number of entities you might have, consolidating some of them probably from a trigger of corporate tax, but even from a commercial perspective, if it makes sense, and being ready to use maybe even transfer pricing and OECD principles to restructure some of your value chain and take benefit of a corporate tax rate, which is probably 9%, still more optimistically competitive as compared to the rest of the world. And some of these, discussions take time to modify, to mold and remold and strategize. And that's where the real opportunity is to really go bottom up and review your P&L, your balance sheet, your contractual obligations in the eye of this new law, and try to make the most of it so that when the compliance due date arrives, it's not simply a tick in the box. It's more to do with, okay, we have understood the overall ethos of why this law has come out. And while the heavy lifting might be done in the year of debut, we've really remodeled ourselves to be ready for the upswing of a new tax world. With that, leading to the next slide, this really depicts as to, from where we see it as tax professionals, collectively from both the Middle East as well as India. This is what a typical, the existing compliance calendar might need to be superimposed by these renewed deadlines. We are in April 2022, gone maybe 3 months of the announcement being happened, and the amount of meetings, questioning, again, realigning some of the strategies while the day-to-day business operation continues. The revenue streams continue, the overall deadlines, whether it's quarterly or annual audits, quarterly or annual filings, as the case may be. But on the backdrop, every decision which is to be taken from here on, being made consciously with having a corporate tax and transfer pricing thought duly given. Again, whether it's about documentation or having some sort of a governance framework as to using this time between now and 1st of June 2023 to align yourself, embrace the change, measure the impact, so as to neither overestimate nor underestimate the final consequence of this new law, and be ready when it comes to the actual compliance in 2024. And again, in my experience, as much as time might appear to be between now and then, it always tends to fall short, given the newness and given the first time event this is going to be from a UAE standpoint. So with that, I'm going to hand it over back to Ajay for a panel discussion and taking the Q&A from the audience.
Right. Thanks, Anuj and Bolu for such a wonderful insights on what's happening. I think the audience has asked a lot of questions. some practical questions of how this will be implemented specific instances. So time permitting, we will take up those questions. We have 1 hour 15 minutes reserved, so we still have half an hour to go. And those questions are very relevant, and we have to factor those in as we plan our way forward. So moving to the next one, let me bring in my Indian tax experts. And from an Indian perspective, how does this change look like? We all know that we have a lot of Indian companies who have chosen to make investments in UAE, and going forward, as Anuj mentioned, that while it may seem that there's an extra cost of doing business in UAE has come about, it's a 9% corporate tax, which is not the case earlier, but it actually lends substance to UAE as a jurisdiction, and therefore does it become more attractive as compared to the rest of jurisdictions which have taxes and therefore are not challenged from the perspective of those jurisdictions being called as tax havens, something like that. So yeah, so Dubai has actually neutralized, or UAE has neutralized this whole notion that it's not something which is abiding with the tax regulations across the globe. So it actually becomes a more attractive place, a very interesting perspective. So looking at from Indian side of things, let me ask Sridhar, how do you see this 9% tax coming in the various structures that you've seen while advising your clients?
Yeah, thank you, Ajay. I can start by saying that nobody likes to pay extra tax, and the way we are seeing it at this point in time is a potential 9% extra cost on an absolute sense. But as we go into the fine print, I'm sure that one, there would be grandfathering that we need to see how that would play out, and two, what would be the 9% on, and that would really kind of be important for Indian parent companies to assess. So what I've kind of done here is, from the previous experiences of having dealt with structures, we've put 4 scenarios that we've seen in the past. The first one being where the Indian parent simply has a branch office in the UAE, and in that situation, while in the past India used to be happy taxing all of that income in India as a branch and as an extension or a PE, for that example. With the introduction of the new 9% tax, we need to evaluate how this would shift the focus from a zero position in the UAE to offering 9% tax on what is attributed to the branch. And to that extent, I would think our transfer pricing colleagues will need to take a much more scientific assessment on what would be the right thing to do in offering that income to UAE. And of course, from an India perspective, our concern would be to make sure that we get credit for any tax that is paid in the UAE on account of this 9% tax. So to that extent, we would be happy to take credit of what is paid in the UAE, and on an overall effective tax basis, the branch in itself would therefore subsume, branch tax would be subsumed within the Indian company's tax. Now, coming to the free trade zone trading entity, so where you form companies, where Indian companies have set up subsidiaries, wholly owned subsidiaries in the trading zone, I would think grandfathering would be the biggest concern for all of us to make sure what happens there and what are the conditionalities that UAE comes up with in terms of making sure if there is an exemption, how does that play out? If there is no exemption, we have to factor in a 9% additional cost. And there, I think the treaty also clarifies that we do not get underlying tax credit. And to that extent, the tax paid by the free trade zone entity, if at all there is a tax, this would kind of become an additional cost for this structure to consider. Of course, payouts by the free trade zone trading entity as dividend while there is no withholding tax in the UAE, India still taxes that income that is received as dividend from the foreign company. If I see model 3 as we see it, an Indian company setting up a free trades zone investment holding entity which could potentially also own intellectual property, although Dubai is not being favored so much for intellectual property, but it is gaining ground in the recent past. And if the investment holding company itself has foreign subsidiaries, I think the key element there is that the assurance from the current reading of the law that dividend and capital gains income of a free trade zone entity or of a Dubai company would be not exigible to tax is an assurance that we would look to make sure that at least capital gains and dividend income do not get taxed in the UAE. And that entity then pools that investment return in the most appropriate manner. To that extent, this structure still remains interesting and viable, subject to how the UAE law pans out. And now, if you see the opportunity, really, the fourth structure, as we see it, is where within the GCC we have seen tax being rolled out in all countries, including the Saudi, Oman, and Kuwait, etc., and UAE following now with this. So, and I'd like to get Anuj here in to take his thoughts as well. But this seems to be some opportunity building up in optimizing tax payouts within the GCC itself, given the overall tax regime in the GCC entity. So would you look at the overall structure and consider a branch in other locations or a branch in the UAE to optimize tax that you may have from businesses in the Saudi, Oman, and Kuwait? And how do credit play out is something that could be an opportunity for us to consider. And if I'd like to hand this over to Anuj for his thoughts, and then from there on to back to Ajay.
Sure. No, thanks, Sridhar. That's really helpful perspective. So I guess from a looking at a branch structure, and I can fully imagine some of these branch structures were set up initially driven by cost parameters and the time parameters. It's pretty easy and pretty cheap to set up a branch structure, and you're not sure, you're just testing the market. But very soon, if success is coming, the same structure tends to get extended for another project. So we've seen some of these branch structures already being tested for its fragility or sustainability, so as to speak, when economic substance came in. Because you are parking huge profits, and then some of our clients, I dare say this, even realized that okay, we didn't kind of foresee the expanded profile of a branch whereby the revenue is expanding and it's being reported to the home country, be it India or any other country, and we are paying full corporate tax because branch is mere an extension and it's a permanent establishment. Now, with corporate tax coming in more so some of these structures will be questioned again more so now on their sustainability. Is it probably better to, if the longevity is still quite visible, is it beneficial to convert some of these branches into LLCs? And there are provisions within the law to do that, and thereby ring fence the country level profits or the regional profits at the UAE level. And then, as you rightly said, if at all dividends need to be given, hopefully what is being promised again is participation exemption, a lot of passive income not being subject to tax in UAE, neither on collection and even on remittance, there's no withholding tax which is being promised. Then net the money reaches the holding company in India or the ultimate parent in India, with deferment of tax, but within the realm of the OECD principles. Again, to some extent, for structures where UAE sits as a through bound, for now we have seen a lot of tax leakage or a sunk tax cost when remittances are given to UAE and withholding tax is applied, be it 5-10%. Now, with corporate tax coming in and the right foreign tax credit measures being applied, whether subject to treaty benefits, effectively this could mean not a 9% tax cash outflow. Effectively, this could mean a much lower but a much more certain tax world, wherein UAE continues to be the cash pooling, subjected to withholding tax, but then it gets credit against its corporate tax liability. So some of these permutation combinations could lead to a much more healthier structure and in sync with the OECD principles. So the question marks on the UAE outfit and the regional structures could be seeing more and more disappearing. And the answer is the correct tax measure and the transfer pricing policy.
Right. Thanks, Anu. Thanks, Sridhar. I guess one of the questions that all international investing community has is that when will India bring in underlying foreign tax credit rules that all the corporates pay while distributing, bringing the profits back into India. But I guess with India, destined to sign BIPA, I guess, very soon, because that's one of the agreements that is out there. That soon the discussion will start. I guess somewhere getting underlying tax credit for the corporate tax 9% will be something that will bring smiles on Indian investing community. So let me now get Manish in. So this is a very interesting concept brought in, Anuj, I think 2 years back or 3 years back. Economic substance regulations brought in, and all the entities incorporated in UAE, especially in the free trade zones, were supposed to they need to fulfill those conditions. And we also have POEM regulations in India. So the question comes to that: if you have POEM regulations which can bring in a foreign entity can categorize a foreign entity as a company managed from India and therefore resident of India, whereas they also have simultaneously in ESR regulations, and under the UAE regulations, I believe there is an annual filing that needs to be done by all those entities. Yeah. We all know that we have 2 years of COVID, and maybe all those requirements may not have been very closely looked at by the regulators, given the world was operating in a very different way. So Manish, what do you think? How will Indian tax, how will somebody in India having entities in UAE with economic substance coming in, do you think the levy of 9% now corporate tax provide additional shield to a POEM risk, this place of effective management risk, which existed even prior to corporate tax coming in? Because if a foreign entity has a POEM in India, it runs the risk of it being categorized as Indian resident and therefore liable to be taxed, and even though the dividends are never distributed. And also we have circular issued by CBDT, which makes things more complicated. So what's your take on that? How do you see this thing panning out?
Thanks, Ajay. So the point is that bringing in of a corporate tax rate in UAE may not per se actually stop Indian authorities of examining those companies which have control and management in India. So Indian held companies in that sense. So economic substance requirements which were introduced in UAE 3 years back had various tests. So one of the tests was about management and direction being in UAE, right? So that test was there. But as you said, that because of COVID, it may have happened that for last 3 years, these tests have not been tested in that sense by the UAE tax authorities, that whether the companies are compliant with this or not. And from the Indian perspective, the Indian authorities, because of these tests not getting examined by the UAE authorities, examine these Indian held companies from a POEM perspective, right? And there we have some risk running in, or there we have some exposures running in for these companies. So that is the thought. So while 9% obviously gives credence to the fact that we are moving towards a jurisdiction which in that sense is a normal taxing jurisdiction, that may not per se stop the Indian authorities from examining this. And just to highlight, in terms of the treaty which India has with UAE, the definition of residency for companies is slightly different. So it talks about a company being a resident in UAE only when its control and management is wholly situated in UAE. So how that would play out is also something which needs to be considered, because Indian tax authorities may go to that definition to take some sort of interpretation, which saying that it gives them some sort of, I would say, leeway to examine these companies in more detail. So that is the initial thought which I have, and I think Anuj can throw more light on that.
Yeah, no, I think I do agree that there are parallels to draw between POEM and the control and manage test under ESR. And I guess while POEM is much more elaborated, control and manage test is a very purpose-driven substance requirement. And while the submissions have been made by various UAE entities, and we have seen some bit of ESR audits also being conducted in the recent past, but those are more on the compliance due dates and any high-level positions. It hasn't gone granular into testing some of these measures. And again, one would expect as information flows, under the automatic exchange of information commitments, if at all an Indian tax authority requests UAE for a copy of ESR and then what has been submitted and how it has been comprehended, and if gaps do appear, then yes, again, going to the anti-treaty shopping BEPS minimum standard, which also UAE has signed up. Yes, we saw a complete overhaul of tax residency certificate, the way it is issued, again, driven by substance and for real transactions. There could still be some open gaps which need to be measured and remeasured. But again, back to my point as to how to use this development as a strategic advantage. So if someone was to really sit down and do a FAR, function and assets and risk review from a TP perspective on both the transactions, mirror transactions, then this is where these loops can be, unlooped and the gaps can be filled in. So using this as an opportunity again is a much better approach as compared to a compliance tick in the box.
Right. I think it's very interesting when you said that for any entity to be eligible for treaty benefit, it needs to be wholly situated in UAE, which may not be worded exactly in the ESR regulations that it should be 100% managed from UAE. It may be worded from an economic substance perspective, which is relevant. So I guess thresholds are different. And I guess that's where the complexity lies as to how the treaty versus the actual ESR regulations play out in practice. Okay, I think we've covered the questions that at least we prepared as a group. So we have a lot of questions from the audience. I think most of the questions are for Anuj and Udo, and I'll just pick them up. Time permitting, we'll cover as much as we can, but if not, we'll make sure that we get the responses in writing. So the first question was from Sushant. Tax paid by company registered in Dubai, also having paid taxes in other jurisdictions like UK, Germany, etc. Is a tax offset option available to the company registered in Dubai? Anuj?
Right. I think this hints towards whether there will be sophisticated provisions enough for any foreign tax credit being set off against a UAE tax liability. So the initial indications are yes. The idea is, and plus, as I keep saying, there are about 120 plus live tax treaties which are in play, and many of them have been rightly modified under the MLI regime as well. So bringing in sync with the BEPS Pillar 1 and Pillar 2 provisions, and if all of them are in play, again subject to residency rules, most of these double taxation measures should benefit the credits being available ultimately in one country or the other. But this is still based on how the actual law gets rolled out. But if I was to look at other countries introducing tax whenever they did it, there's no intention to double tax the same income and do provide due credits whenever legitimate.
Right, I guess we're looking at a pooling set of regulations coming in and carry forward of tax credits, how many years. So I guess detailed regulations will provide more clarity. So the next question is on the start of the tax year. So for entities, it's from Vishal Shah, for entities having financial year from April to March, the applicability shall be from financial year starting April 2024. I guess that's the question he's asking. Even though the regulations, June 2023 is when the law comes in.
Yeah, that's right. Your first tax year for your specific entity would be 1st April 2024. But if you are already undertaking transactions from 1st June till 1st April 2024, while you will not be responsible for reporting that in your tax filings, probably somebody else would, like your supplier or your contractor, which means you need to be careful anything from 1st June 2023 to make sure that your side of the transaction is clean from a corporate tax perspective.
Right. I guess we covered this, but still reconfirmation, will taxes be applicable to free zones? Answer is yes, but the transfer pricing regulations also will apply, and I guess we're anticipating filing requirements also to be a part of those requirements. So we'll have to sort of wait and watch to what extent there is a leeway given a free trade zone. So Anuj, any regulation that is apart from payment of taxes, do you see any other relaxation coming in for maybe thin cap not being there or something like that?
I guess we again, I mentioned about thin capitalization rules. It's an anticipation we are keeping. It's nothing coming from the official FAQ or the communication from the ministry. And the reason for them being, simply speaking, that we are so used to seeing shareholder loans, intercompany loans being given, that unless there is some level of a cap on these expenses, leave alone, transfer pricing governance on such related party transactions, one would see the overall soul of this new law being diluted. And again, back to a 9% highly competitive rate. Of course, nothing is as competitive as zero, but the delta has clearly moved owing to the global developments. The inclusiveness and the overall application of the law, I think that's where UAE is going to get measured on successful implementation. And mind you, I keep saying this, whether it was ESR, CBCR, and now Pillar 2, 15% rate coming in. The overall judgment is at the EU level, at the OECD level, right? The Code of Conduct Committee, we know, is conducting peer reviews, and one needs to, as a federal, keep passing those tests progressively year on year. And hence, some of these measures will help UAE as a federal to keep passing in flying colors and saying, okay, fine, we are in all likelihood, in all legitimate reasons, a taxable country, and we have the right measures and levers in play to ensure no abuse happens and only the right allowances are given to reach the taxable base.
Right. And I guess, since you're talking about allowances, one of the questions was on the basis on which the corporate tax needs to be calculated, given that there are no accounting standards, financial reporting standards that are out there. So any guesswork, anything they want to predict how it might look like?
Yeah, so again, most of the entities within UAE, and this is again governed by the Department of Economic Development, which monitors the mainland entities, and many of the free zones, who are the authorities for free zone entities. They have been wanting to ask for IFRS-based financial statements, whether on renewal or any banks or any loan-related transactions. IFR is a standard which is fairly accepted for accounting purposes. That will always be the starting point. And then you will derive the taxable income from the accounting profits based on how the taxable base is computed under the law.
Right. Right. I think there are a lot of other questions. We'll actually, answer them as we we'll try to answer them on a one-to-one basis. I guess it's time to sort of make a summary of what all we discussed. I think we discussed a number of things, but my personal sort of takeaway has been that this 9% tax is a good thing, while introduction of tax is always, seen as cost of doing business. But I guess from looking as a outsider, we believe that doing business in UAE is pretty costly as compared to some of the other jurisdictions. So I guess some amount of, I guess the cost of living and the way the whole economy runs, if that can be looked at, then UAE can become more than just the sort of the conduit, if you like, which is not there right now also, but it can attract much more, and it can really achieve the potential. As far as I guess the globe rules are concerned, although it's a 15% tax rate, but I guess UAE has taken a middle path of still going to 9% only. I guess leaving the rest to maybe some other jurisdictions, so they're happy collecting 9. We don't know how it might shape up. And obviously OECD is doing a lot of work, and MLI is going to be released, how that global rules will be implemented. From an Indian perspective, I see definitely an incremental tax, which have a presence in the UAE market. But yes, you're right, Anuj, you mentioned that it's going to be seen as very healthy. Overall, it may not be very, I would say, costly. Of course, a lot of structuring options, a lot of details will have to be looked at. And I think you mentioned rightly that it's not something to wait for the rules to be announced. People need to look at the current structures, look at what's being done, the way the business is being run currently, the kind of operations, the value chains. Is there an opportunity to just shift the value chain and take more out of what's being offered? So these are sort of key takeaways from what I see. So at this moment, I can sort of take this opportunity to thank everyone who has been part of the conference. Hope it was useful, worth your time. And on behalf of all of you, I thank the panelists also. And if you have any questions, you can either write to Anuj or myself. We will be sending the link of this webinar to everybody who registered, including, of course, the one who attended. You can take a look at it. I think some people asked about the detail of the presentation. So not only the presentation, you will have the full link being sent to you. So with this, I can formally close the webinar and thank the panelists again for being generous in sharing their thoughts and ideas. So clearly, this is not the final word on this. This is just the tip of the iceberg. We hope to come back to you again in periodic intervals as we see the trends, as we see movement happening in the UAE tax landscape. And until then, take care, stay safe, and hope to see you again.
Thank you, everyone.
Thank you, everyone.
Thank you.
Yeah, thank you.